Okay, well, here we are, another Sunday, another weekly outlook. Friday was options expiration day last week, and we had a significant sell-off. Kind of hard to pull those two things apart. Was there something about options expiration that required some selling, or was it a more fundamental story about what the FOMC is going to do? And I think options expiration has something to do with it, but I think a big part of it was the expectation that the Fed was actually going to be higher for longer, because the shape of the yield curve changed in such a way that it indicates that the market is starting to consider a higher level of rates for a longer period of time. So I'll show you how to tease that apart, and then I will show you a really neat model that the Federal Reserve has on its website, and I'll try to draw out what that model is doing to show you how you would draw out the shape of the yield curve based on expectations, and then some quirks based on liquidity preference. So let's have a look at what happened here. Money market rates, notice for last week they all hit new highs. They're all slowly working their way up to the expectation of what the Fed is going to do for the year. Not a lot of big moves in here. If we look at capital markets, they did increase on capital market rates. The interesting change happened here is the slope of the curve is less inverted than it was last week. By 14 basis points. Not that the two changed. If we look at the 2-year yield, last week it was 325. This week is 325. 325 still being the high of the year. The 2-year is sitting at the high of the year. It is the 10-year that is moving up, and that's why I want to draw out how can we recover the shape of the yield curve based on expectations. Based on expectations of the path of the short rate only, assuming that maturity premiums are always positive. And if we assume maturity premiums are always positive, whatever short rate we have would imply an always upward sloping yield curve. Well, then how do we get this? And because the 10-year is increasing, I'm going to explain what that means, or how I come to the conclusion that the market is seeing the short rate higher for longer. Next FOMC meeting, September 21st, that is 31 days away. Lots of time between now and then for data to come out. I think we have a PCE next week. We will also have a September jobs report before then, and I believe we will see one more CPI and one more PPI for the month of August, which is reported in September. So we do have 4 more big, potentially moving events. Well, I say moving our expectation of what we think the Fed is going to do in September. So we are still inverted here. This is now 45 days of an inversion, and we know that we're looking at the 2 Ds, right? Depth and duration. Well, duration only moves in one direction until there is no more inversion. Direction's moving has increased to 45 days. Depth, we are 14 basis points less inverted, and we'll, as I said, I'll draw out on the next screen what that would look like. The balance sheet, the Fed's balance sheet, is going in the right direction for the week ending August 18th. It has dropped almost 13 billion. So month to date, the Fed's balance sheet is down 30 billion. It still has some MBS left to buy. So it is going to increase. I shouldn't say increase. The increase in the MBS is going to offset that roll-off. This is August. Keep in mind, once we get into September, treasuries go to 60 billion and MBS go to 35 billion. Now they've already, we'll read the minutes. In the minutes they say they're not going to hit the 35 billion because not enough is rolling off in September. Not enough principal is coming in to equal 35 billion. So they won't hit this. They also won't hit the 60 billion with coupon paying bonds, which means they'll allow some bills to run off. And when you allow these bills to run off, when you don't replenish them, that means there's a greater supply, so there'll be less pressure on the reverse repo market. There'll be less use of the reverse repo. look at OAS over here. Investment grade has pulled in 1 basis point. This should be green. I don't know why it's red. I didn't change the colors here. I'm being lazy, but imagine that they're green. High yield is increased by 16. Double A dropped by 1. Triple B dropped by 3. They're both investment grade, the top end to the bottom end. And then for high yield here, we had a 17 basis point increase and almost no change on the triple C. When we're talking about reducing demand or working on aggregate demand to reduce inflation, aggregate demand comes from 2 things. It comes from the sum of all incomes in the economy. People have that money, they can spend that money. It also comes from the sum of all the credit available in the economy, because I can spend every penny I make and then use my credit card. Or I could go get a loan. Or I could get a loan to buy a car. I could get a second mortgage or a line of credit on my house and go spend it. So credit is, in a sense, money creation. So when you tighten financial conditions, the first thing that you expect to happen is that you will reduce the amount of credit without hitting income, so that you can reduce the amount of spending in an economy without actually hurting anybody's jobs, because you're taking away that credit component. Well, when you have yields that are lowering, that does not speak to tightening credit conditions. That actually is loosening credit conditions. So when we look at the OAS and we see that yields keep coming in from where they were 6 weeks ago, that means since the last Fed meeting, we can not even say 6 weeks, we could just say since the last Fed meeting, credit conditions have loosened. There is more credit availability. So this, instead of coming down, has been going up since the last meeting. This is where the Fed hopes that it can reduce aggregate demand, is with credit creation as opposed to hitting incomes. The problem is, this is part of spending. If you reduce credit creation, you reduce spending. If you reduce spending, some companies are going to say, well, we don't need some people, and you have no choice but to hit incomes. It is kind of like, you can choose 3 things, or there are 3 things available for you, but you can only choose 2 of them. So you can have higher rates with lower inflation, but you can't say we're not going to lose any jobs. You can have lower rates and not lose any jobs, but you better live with higher inflation. So you can't have your cake and eat it too. You have to have a trade-off. And in the Fed minutes, we're going to see that they're perfectly willing to make the trade-off on employment, because they feel employment is overheated anyways. When they looked at the minutes, it was 3.6. We know it's 3.5, or at least the data is suggesting a measurement of 3.5. They're perfectly willing to trade that off to 4% or even 4.5%. So I don't know that a slowdown in hiring is going to do very much. I don't think that a small tick up in initial jobless claims is going to do very much to change their mind if inflation still exists. And speaking of inflation, what inflation? I'm not saying what inflation is, it doesn't exist, but when we say inflation, what measure of inflation are we actually paying attention to? It's not as simple as what you think. So we're going to go through a number of inflation measures, and we're going to plot the Fed funds rate over a period of time versus multiple different inflation rates. And there's something very surprising about what you'll see. What I want to do right now is I'm going to show you a link for something called This Week in Credit. It's issued by S&P Global. It's issued with a delay because they want you to pay for it. If you don't pay for it, they say, well, we'll tell you what happened 2 weeks ago. So it gives you a sort of a backwards look. You can't have today's because it's a paid subscription, but we can get some information from 2 weeks ago. I'm also going to show you something really interesting, the Fed Watch tool on the CME. So I've been taking the Fed funds futures contract that expires after each Fed meeting to figure out what the market is pricing in as the most probable move. Not the probability of a particular move, but the most probable move. And the most probable move is the one that is closest to 100 without going over. Well, this tool uses the daily average of all the Fed funds contracts over a period of time to calculate the probability that the market thinks on each move. So right now it's saying there is a 59% probability of a 50 basis point move and a 41% probability of a 75% basis move. This is objectively derived from where the futures contracts are trading. So it's basically saying this is the market collectively placing these probabilities on there. You can agree with the market or disagree with the market. Let's look at these tools, and then we'll go to a screen and I will attempt to show you how we get this curve by doing nothing more than forecasting the path of the short rate. Okay, this week in credit, this is from August 8th. As I said, if you're going to get the free version, there is a delay. So you're going to be a little bit backwards looking, but week over week over week, you can see what the trend was up until 2 weeks ago, and maybe you'll see snippets about this in different news reports that have more timely information, so you can sort of build a trend up to about 2 weeks ago. So what do we have here? Ratings actions, rating transitions, industries most at risk, and ratings at a glance. And we have upgrades, 8 upgrades. Notice the down arrow, and it tells you the arrow indicates week over week trend. So 8 upgrades is down week over week, meaning the upgrades are getting fewer and fewer. Downgrades, there were 8 downgrades, which is up week over week. Positive OLCW changes. OLCW means Outlook and Credit Watch. So 9 have been tagged with a positive Outlook or a positive Credit Watch. However, and that is down from the week before. Look at this, 30 are now on negative Outlook and Credit Watch, and that is up from the week before. So this trend is all suggesting downwards in terms of risk, or upwards in terms of risk, but downwards in terms of ratings. Rating transitions, rising stars, falling angels, 0-0, risky credits. Risky credits are those that are triple C. Or lower. So those that have moved into the triple C category 3, that is up from last week, 1 default. Industries most at risk, consumer products. Negative outlook bias. What does a negative outlook bias mean? You take the percentage of the issuers in this particular industry, the percentage of issuers with a positive bias, and you subtract the percentage of issuers with a negative bias. So being that this is negative, there are more issuers with a negative bias than with a positive bias. Potential fallen angels, 5. This is in consumer products. What is a potential fallen angel? Triple B minus, the lower part of the investment grade, that are now on the watch list for negative outlook or credit watch. So that they're called potential fallen angels, falling out of investment grade into high yield. Weakest links in media and entertainment, 42 weakest links. A weakest link is a B minus. You're rated B minus with a outlook, a negative outlook, or for credit watch, a negative bias for those. U.S. distress ratio, 6.2. This is the percentage of high yield issuers with an OAS greater than 1,000 basis points relative to treasuries. So 6.2%. It is down week over week. So that's not a bad thing. But when we look at the OAS over the last few weeks for high yield, we have noticed that it has come in from, well, a high, I think, on early July, almost 600 basis points, now 437 basis points. So that's consistent. Then you have ratings at a glance. There's more here. This is speculative grade bond and leverage loan issuance, and there is 2022. You have some comparisons, benchmark yields. There's the U.S., the 10-year, the secured overnight funding rate. You have Germany and Australia in here. Secondary market credit spreads for the U.S., SG, speculative grade or high yield. There's investment grade. And this is spread, the spread 479 versus the 5-year average. So we see the spread is just a little above the 5-year average for speculative grade in the U.S. and just a little above the 5-year average for investment grade. You can see the big difference here in Europe. Europe does have a little bit more trouble. I shouldn't say a little bit. They got a big looming problem coming up this fall. Europe is kind of a market I don't think you want to be in right now. And then corporate debt issuance. So it's just, when they say at a glance, it really is at a glance. If you just want to sort of keep your eye on this dashboard. Top 10 upgrades and downgrades by debt. And down here you have all of the terms. So if you forget what I said, what all those things were, they're all down here. And that is This Week in Credit. Link is in the description box below. All right, here's the Fed Watch tool. It tells you, it gives you a nice little countdown. You can maybe make that a screensaver, right? Wouldn't that be a cool screensaver? 31 days, 3 hours, 6 minutes, 12 seconds. Sorry, 11 seconds. Sorry, 9 seconds. You get what's going, right? Click over here, September 21st. Here are your probabilities. That the target range will be 275 to 300. Right now it's 225 to 250. So this means a 50 basis point rate hike. 59%. This is a 75% or 75 basis point hike, 41%. You can also click over to the November meeting to see what the probabilities are there. You can click for December, you can click for February, and it'll give you the range of possibilities and the probabilities for each one. And you can look historical, you can look, there's a whole bunch of interesting stuff along the side that you can look at in terms of probabilities. It'll give you a probability table all at one time for, these are the different Fed funds futures contracts, and it'll give you sort of a probability of where the most likely probability is in blue of where the range will be at each of these particular points in time. So I thought you might like to have access to that, so at any given time you can see exactly what the market is pricing as the probability of a certain rate hike for a particular meeting at any point in time, as opposed to calculating it from the futures contract yourself. Okay, let's draw out the current shape of the yield curve right now, and all we're going to do is change the path of the short rate. And the short rate will be based on some forward rate model that we use that predicts not the forward rate based on the current yield curve right now, but predicts out the what the forward rate will be as it evolves over time. So let's just start with 0 just to make a point here. Let's say that the short rate, the overnight rate, is 0. That means that all we should see in the yield curve is term premium. So we'll just draw a line up like this. And all this is saying is that as we go further out in time, even though the short rate is 0, we should get something more than 0 just for maturity. So that is just the upward sloping curve for a maturity premium. And at all times, we will have an upward sloping curve. We will assume that the maturity premium is constant over time, meaning that if a 5-year maturity premium is 20 basis points, no matter where the short rate is, the 5-year will be 20 basis points higher no matter what. So this is where we are. This is our starting position. Let's say after 1 year we expect the short rate to be here, after 2 years to be here, and after 3 years we expect it to be there. So let's draw out the same curve over a 3-year period. There we go. So that is 1 year, 2 years, 3 years. For year 4, we expect a moderation. We expect it to come down a bit. There's year 4. For year 5, we expect it to come down a bit more. There's year 5. Year 6 maybe will just be a little above year 1, and let's say by year 10, we're all the way back down to here. So what we'll do now is we will put our 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Year 1 was here, year 2 was here, year 3, year 2 was this brown line, year 3 was here, year 4 was here, year 5 over here, 6 was just a little above, and then 10 was all the way over here. And we draw out the shape of our yield curve. And there is your inverted yield curve based on the path of the short rate. So what happens if we think that the 10-year rate, if we draw it out again, I'll just do it quickly. We had the overnight rate. There's our 1-year rate, our 2-year rate, our 3-year rate. But we think it's going to be there for a while. So Our 3-year rate stays here. Maybe our 4-year rate is here, the 5-year rate, and we'll keep going down, but the 10-year rate won't reach the same point as it did before. So you'd have the 1, the 2, sorry, the overnight rate. Do that again. The overnight rate, the 1-year, the 2-year, the 3-year. Then you would have the 4-year, the 5-year, and all the way out to the 10-year out here. Let's just say it looks like that. So if we drew out the yield curve, it would now look like that. Notice that it is less inverted. It is less inverted because we're predicting that the path of the short rate is going to stay higher for longer. It is not going to drop. Notice that over here we went up to 3 years and then we brought it right back down. Here we went up to 3 years and we slowly brought it down, but not all the way down. That will raise the longer end of the curve. Typically, when yield curves are inverted, they have resolved themselves by the 2-year rate dropping, because it does tip the economy into a slowdown and the Fed pulls down the short rate, which is why we say an inverted yield curve is a predictor of a recession. But here we had a less inverted yield curve by 14 basis points. Not because the 2-year moved, but because the 10-year increased. The 10-year increased because the path of the short rate is expected to stay higher for longer. And so because of that, by the time you draw out the curve, you'll get something like that. Now you may say, but hang on a second, the curve looks like this at the 20-year and then comes back down at the 30-year. How do you begin to explain that? Well, this over here is called expectations. If you have been through level 2 CFA, in the first reading of fixed income, you get to the theories of the yield curve. The first one you get to is called pure expectations. That the forward rate is an unbiased predictor of the future short rate. And then you just have to have some model that maps out the path of the short rate. And when you draw out the path of the short rate like we did here, from here, 1 year, 2 years, 3 years, 4, 5, 6, you can then draw out what the shape of that yield curve is going to look like over time. What we can do is we can add the second theory, which is called liquidity preference, and say, well, there is some preference for the 10-year and some preference for the 30-year. That there is more demand for the 10-year and the 30-year than the 20. That given a choice between the 10, the 20, and the 30, there's a group of buyers that say the 10 is far more useful for us than the 20. And another group of buyers that say the 30 is more useful for us than the 20. Hence, there's not that much demand for the 20 as there is for the 10 and the 30. So you may get small little kinks in the yield curve like that aren't explained by pure expectations, that can be then explained by overlaying liquidity preferences on certain parts of the curve. And that is, well, a little bit technical, but that is how you would get your yield curve sloping like that. You need some forecast of what is going on here. And being that we have a curve that is less inverted now, it has to mean that the market is expecting the short rate to be higher for longer. Let's look at what the Federal Reserve has available for us in terms of a model that already, they have a model that they use to predict the path of the short rate. Okay, link for this is in the description box below. This is, you'll get to federalreserve.gov/data. Click on data, and way down here, other, you have yield curve models and data. And we'll click on the 3-factor nominal term structure model. It'll give a brief description of what's going on. You can go to the HTML, and again, this is delayed as well. This is all the way to August 12th because they use it for their own internal purposes. They're not going to give you timely data, but they'll give you something more historical. And then you have a series of 10 rates, number 1 all the way to number 10. And then you have, I think, 4 different independent variables, 10 versions of them depending on what rate it is. So you got 40 independent variables in here, and it gives you the definitions of the term based on what the prefix is. So you have the fitted instantaneous forward rate, x years hence. You have the instantaneous forward term premium, x years hence. So if you want to know what the future short rate will be, you'll look at the forward rate and you'll subtract out the term premium at that point in time, because if you calculate a forward rate between years 5 and years 6, because, as I drew out on the previous screen, we assume an upward sloping maturity premium term structure. Within the 5 and the 6, there's going to be a maturity premium difference between that 1 year, which will get smuggled into the forward rate. So it gives you the maturity premium with a negative coefficient in front of it, so you know to subtract it from the instantaneous forward rate XX years out to know what the path of that short rate will be. So if you want to play around with this model, you can. All the independent variables are written across the top, and there are 40 of them. I put it in HTML here, but you can download it into a comma-separated file and import it into Excel and play around with it if you are on the technical side that way and you want to explore something more than maybe other models that you're looking at, or you want to see exactly how they're modeling it. Have fun. Okay, let's look at our real yields and our break-even rates. Not much of a story to tell here. Real yields went higher all the way out to the end, except the 30. But these are such small moves. These tend to be a little bit bigger, so there's some meaning here. But I don't know that I would put too much meaning in here. This is interesting. All the break-even, the inflation break-even rates increased over that period of time. I don't know what to read into that, being that we're thinking if the thought over the week was higher for longer, I would have assumed that the break-even rates would have either been unchanged or had dropped, but they have actually increased. So it almost suggests that the Fed is going to cut rates too soon, whereas the slope being less inverted suggests that the Fed is going to be higher for longer. You're not going to get everything pointing in the right direction. So being that it seems at odds and that this is more of a residual of where the real rates and the nominal rates are, I'm not going to read too much into that. I just find it interesting that they increased week over week. Mortgage rates. This market is tightening again. We're at 5.6. Last week was 5.33. The high was 6.11. And they had dropped all the way down to 5.08% at one point and now are going back up. This is not what the Fed wants to see, mortgage rates dropping. FHA is at 5%. Last week was 4.72. Lots of signals that the housing market is really taking it on the chin here. Mortgage apps down 2.3%. Refis are down 5.4%. Purchases down just a little under 1%. That's for the week ending August 12th. This is really interesting here as well. This is the week ending August 13th, 2022 versus August 6th, July 30th. Look at the median listing prices, up 13.3% year over year for the same week year over year. Was 15.5, was 15.6. At one point it was 16.6, so that's the biggest drop down I've seen for a while. New listings and active listings are both lower. This is new listings. Houses aren't making it onto the market at the same pace year over year. We're down 15% instead of being down 8%. We're up 27% on total active listings, but it was up 28% last week. Houses are selling 5 days slower year over year. So they were selling faster week over week last year, 5 days faster last year. None of the housing data last week was good. The housing market index at 49. This is a diffusion index. Anything over 50 is growth. Anything under 50 is contraction. So to say that the housing market is in a recession right now, that we have pockets of recession, but maybe not an economy-wide recession, well, we are in contraction in the housing market index. Building permits for July down 1.3%. Housing starts for July down 9.6%. Existing home sales for July down 5.9%. Median selling price for the existing home sales, median price $403,800 versus June was $413,800. So you had a 10% drop in the median home price sale. But that could simply mean that, it could be that prices are dropping, or it could be that the market is moving towards the lower priced houses in the market. It's not clear enough what is going on, but I would seem to think that housing prices are dropping. All this data is consistent with a market that is in contraction. None of this stuff is positive. The affordability of homes are dropping. You have interest rates rising, fewer people taking out mortgages. You have a slowing down of the year-over-year price increase. Houses are selling, taking longer to sell. None of this housing data is positive. Well, what did we think higher rates was going to do? Which brings up an interesting point. We know that there is an inventory problem in the U.S. If housing prices are dropping and homeowners are saying, well, I'm not going to list my house at this point in time, I will wait because, that is lower week over week. This is lower week over week. So it seems like that is sort of, pulling back as well. It's in 2007, 2008, there was a housing overhang. There was way more supply. So there was a big hollowing out in home builder returns for a long period of time. Well, that's not the case now. So given all of this data, are home builders something we should be looking at? So let's, before we read the Fed minutes, let's have a look at a chart of the home builder ETF. Okay, this is the 5-year chart of HXB, which is the Home Builders ETF. Not much of a dividend yield, 0.78%. Weighted average PE, 10.29 on a trailing 12-month basis. I don't have a forward earnings estimate for this because that would require a forward estimate for each of the components, and then I would have to multiply them by their weights to get that. I looked around to see if anybody had published a forward estimate on any of the ETFs. Couldn't find anything. Going to retail sales, and we will look at the retail sales report. It breaks it down per segments. There is one segment called building material and garden equipment. Month over month was up 1.46%, which is 19% annualized, versus retail sales as a whole were flat month over month. This category was up 1.46%. You can see the red candle at the end here representing Friday's pullback, and this was the rally from the bottom. Three of the home builders, Lennar, DH Horton, and Pulte, I looked at. Lennar is, given their current price, they're 18.5% above their pre-pandemic high. So this is the pandemic itself. We tend to just ignore this kind of stuff. This is pre-pandemic, and pre-pandemic we had low mortgage rates, you had low inflation, and you had rising home prices. Not to the extent that we had in 2021 and early 2022, but you still had rising home prices. And these were the highs for the ETF. Lennar is, given its pullback from its highs, is still 18.5% above its pre-pandemic highs, and here we have low supply, yes, but we still have some labor material shortages. You got rising rates, which is going to make mortgages more unaffordable, and we still have a high level of inflation. So here you had the Fed at your back. Here you have the Fed standing in front of you. So I would want to see these approach, or at least pull back closer to the pre-pandemic highs, only because if these were the pre-pandemic highs with tailwinds, and these are headwinds, yeah, sure, we got low supply, but you had low supply back here. I still think that this has some downside. DH Horton, 20.67% above their pre-pandemic high. Pulte is 9.5% below its pre-pandemic high. So you have to say, well, why is that? On a relative basis, I don't know that the market would make such a mistake on a relative basis like that to have it lower. There must be something specific to that home builder. I'd want to do a little bit of a deeper dive, but just looking at its chart, I'd probably be interested in selling $35 puts. On the HXB, I think as it gets closer to its last low point, 52.50, given that its pre-pandemic highs are below that, on any sustained pullback, if we continue to get weakness in this market, which based on the housing data, And if rates are going to be higher for longer, mortgage rates are going to be higher for longer, I would expect more downside. Besides, a lot of this was fueled by, we still had very, very low rates, very low mortgage rates all the way through 2021 into early 2022. You had a Fed at your back buying mortgage-backed securities. Mortgage rates are based off of the yield on different mortgage-backed securities. So when you have an insensitive buyer in the mortgage-backed security market, mortgage rates just keep going lower and lower and lower. Well, you don't have that anymore, so I don't know that I like anything above the white line. I'd be interested in anything below, so I'd be looking at puts as we start approaching the lows of 52.50. I'd be looking at selling puts somewhere around the 47.50, but this yield just doesn't turn me on to say, well, you know, even if it gets put to me, I get paid to wait. I'm not being paid enough to wait. I'll do a lot better in XLE, and we'll look at the energy ETF later in this video. The XLE has a nice big fat dividend and I think far better near-term fundamentals than home builders have, but it's on my watch list because you know, you usually make your biggest gains long-term by being a contrarian, buying out of favor stuff. When everyone is selling it and there's no reason to buy it, that's when you buy it and you say, look, I'm not a trader, I'm an investor. Thank you very much. Let me tuck it in the corner of my portfolio. I'll come back in 4 or 5 years and I'll just leave it there. It just, here is not good enough for me yet. Okay, we're going to be on the topic of the Federal Reserve for a little bit of time here, because right now it is the only game. That's all everyone's talking about, is where are they going to go. So we should try to think deeply about what they say, what they have said consistently over the last, since Jerome Powell's train wreck of a press conference. Every Fed official has come out and said, you know, we're not going to pivot. We're going higher. Some have said, you know, we'll stop at 3.5. Some have said 4. Some have said over 4. But they've all consistently said, we're not just going to turn around and go home. We're going to keep it there for a period of time. Much like they did when they lowered rates. They said, we're going to keep rates for low for a long period of time until we're absolutely certain the recovery is well underway. I think they're going to do the same thing with inflation. They're going to keep it at a certain level for an extended period of time until they're absolutely certain inflation is out of the system. Let's, I highlighted certain parts, so we'll just scroll to the highlighted parts and we'll read that. The overnight reverse repo, because we should pay attention to that. The overnight reverse repo agreement facility continued to support policy implementation, and balances remained elevated. Again, we've said, as I said in previous videos, it's elevated because there is a shortage of T-bills on the short end. So if you can't buy those T-bills to get that very safe rate, you can always run to the Fed. The deputy manager anticipated that in the near term, the evolution of take-up on the reverse repo facility would continue to depend on changes in the supply of safe short-term investments and the demand for such investments by money market mutual funds. The reverse repo balances were expected to decline over time as balance sheet runoff proceeded. The deputy manager noted that this process would involve adjustments across a number of markets. It would involve adjustments across a number of markets, which is an interesting statement. I don't know what those adjustments are. And that staff would continue to monitor developments in money markets closely. So maybe we should too. Regarding expectations for the evolution of the Federal Reserve's balance sheet, market participants expected the committee to increase the monthly caps on the balance sheet redemptions beginning in September, as announced in the plans for reducing the size of the Federal Reserve's balance sheet issued in May. Treasury coupon principal payments would first fall below $60 billion in September. So what they're saying is the cap is 60, but we're just not going to have Treasury coupon principal payments at 60. It says here they will fall below the $60 billion cap with the remainder of redemptions met with maturities of Treasury bills. Well, if you have maturities of Treasury bills and you're not replacing them, you're not in competition with money market funds for those very securities, so it should begin to reduce the demand for reverse repos. Paydowns of agency mortgage-backed securities were projected to fall below the higher September cap of $35 billion beginning in September. So even though they say, well, we'll let 35 billion of principal run off, they're saying right there, it's not going to hit 35 billion. So for September, we will probably get that 60 billion in treasuries, combination of coupon paying and T-bill, but not the 35 billion in mortgage-backed securities. Staff review of the economic situation. U.S. real gross domestic product had declined over the first half of the year. However, the labor market continued to be very tight. Not tight, they wanted to use the word very, very tight, and labor demand remained strong. Consumer price inflation, as measured by the 12-month percentage change in the price index for personal consumption expenditure. Notice what they're referring to when they say consumer price inflation, not the CPI. The 12-month percentage change in the price index for personal consumption expenditure. Another interesting thing about that statement is that's a backwards-looking statement. So we're going to look at a number of statements, a number of different measures of inflation that are forward-looking based on some average of the past as opposed to just year over year. So anyways, this remained elevated in May, and available information suggested that inflation was still elevated in June, which it was, but they didn't have the July numbers. Consumer price inflation remained elevated. Total PCE price inflation was 6.3% over the 12 months ending in May. And core PCE price inflation, which excludes changes in consumer energy prices and many consumer food prices, was 4.7% over the same period. The trimmed mean measure of 12-month PCE price inflation constructed by the Federal Reserve Bank of Dallas was 4% in May, 2.1 percentage points higher than its year earlier rate of increase. So we're going to look at this trimmed mean measure, and we're going to look at a forward-looking measure for this as well. In June, the 12-month change in the consumer price index was 9.1%, while core CPI inflation was 5.9% over the same period. So they mentioned the CPI, it's last, the PCE was first. They then went on to the trimmed mean PCE. They mentioned the CPI because, well, it's there, but they don't labor on it. So I don't think we should either. I think the PCE is where we want to be. Secured overnight funding rates remained soft relative to the reverse repo offering. Soft meaning that it stayed below the reverse repo rate, with downward pressure on rates attributed to continuing declines in net treasury bill issuance. That means from the treasury, you have declines in net treasury bill issuance. Why would you have declines in issuance? Usually short-term debt like that is for operational issues. Right now, with inflation where it is, tax collection has never been higher, because you get raises on your paycheck, but you pay taxes based on that raise. So the Treasury is collecting more in tax revenue than ever before without raising tax rates, only because that wage rate you got to cover inflation gets taxed away. That's called inflating away the debt. What happens now? Net decline in net treasury bill issuance. They don't have to issue as much debt. Elevated demand for collateral in the form of treasury securities and money market funds, maintaining very short portfolio maturities amid uncertainty about the near-term outlook for policy rates. They don't want to break the buck, which means they need securities that have almost no duration at this point and nothing but coupon, which means 30-day bills. Well, everyone's fighting for these 30-day bills. Money market can go out to a year, but you get duration mixed up in that 1 year rate. It's small duration, but it's still there. Not so much in the 1 month or even the 3 months, so there's huge demand for it. Consistent with the downward pressure on repo rates, daily take-up in the reverse repo facility increased. But we know they're going to let some bills run off. There's reduced issuance. Now there'll be reduced demand. That should lighten that up a little bit. What else we got here? The volume of ratings downgrades on speculative grade credit in the corporate bond market was similar to that of upgrades in June, which we just saw this week in credit earlier. Similar in June, while for leveraged loans, the volume of downgrades exceeded the volume of upgrades in May and June. Delinquency rates on commercial real estate loans in commercial mortgage-backed securities declined in June. Delinquency rates on small business loans were little changed, and the credit quality of municipal securities remained strong. The credit quality of households stayed solid. Residential mortgage delinquencies and the share of mortgages in forbearance trended down. Credit card and auto credit delinquency rates rose somewhat over the first quarter, but remain subdued by recent historical standards. Credit quality is good. This does not sound like a credit market that is in trouble. Same when we looked at the OAS, that does not look like a credit market that is in trouble. Now, the Fed is concerned about credit markets getting into trouble, because if there is going to be trouble in the credit markets, they got to run and save that. They got to run and backstop that, which means, yeah, you could have a pause in the rate hiking cycle, or even a lowering, or even a pause in the balance sheet runoff, depending on what kind of crisis you have. So it's important for us to recognize that the Fed recognizes that there's no problem in credit markets. Yeah, sure, there's little things here or there, but compared to historical standards, this is really nothing. So if we're looking for something in the credit market to say, hey, Fed, you need to stop, it's not there. So we can't look to the credit market to stop this tightening cycle. The staff provided an update on its assessment of the stability of the financial system and, on balance, characterized the vulnerabilities of the U.S. financial system as moderate, down from notable in January. So in January, they said it's notable, and that's when the market thought, well, they're not going to go too far then. Well, it's not notable anymore. It's down from notable to moderate. Again, another hint that's saying the credit markets aren't telling us to stop. The labor markets aren't telling us to stop. Let's see if they say anything else in here. Residential real estate prices continue to rise. Well, this is before they saw the recent data. It has been dropping now. And the staff noted that although valuations have been elevated, mortgage underwriting standards have been stronger than in previous house cycles. CRE prices continue to rise and valuation pressures appear to be increasing. Underwriting standards have been stronger than in previous housing cycles. They're not anticipating any kind of support that will be required for the housing market. That gives them a green light to raise rates. The staff assessed that households were in a better position than in the mid-2000s to weather a downturn in house prices, noting that mortgage debt growth had significantly lagged growth in house prices, leaving households with substantial equity cushions. And that is true. If you look at the ballooning of mortgage debt, it is way behind the ballooning of house valuations, which means you have a big spread between the amount of debt and the valuation, so your equity cushion is fairly large, leaving households with substantial equity cushions. Moreover, for much of the past decade, most new mortgage debt had been added by borrowers with prime credit scores. In addition, the staff assessed that business leverage was high, but businesses maintained ample cash on hand and their credit quality remained strong. Further, the ability of most firms to service their debt was at historically high level as measured by the interest coverage ratio. They are not concerned with the housing market. They are not concerned with corporate debt. They're not concerned with the quality of the borrower or the ability of either the corporate borrower or the household to withstand a recession. This is not a concern for them. It's not a concern for us either. Recently concluded stress tests suggested that participating banks could absorb losses from a severe recession without breaching regulatory minimums. They're not worried about the banking sector either. Leverage at hedge funds and life insurance companies remain relatively high. I don't know if they're there to backstop hedge funds. Staff economic outlook. The projection for U.S. economic activity noticeably weaker than the June forecast. So here is the first sign that we can say, well, the Fed might pay attention to this. They're not concerned about balance sheet runoff. They think that's going to help the money market fund and the money market altogether. They're not concerned about the housing market. They're not concerned about credit. They're not concerned about the ability of banks to withstand a severe recession. Here we're starting to see, well, there's this economy thing, right? While the projected level of real GDP remained above potential this year, okay, so when I read that, I highlighted, okay, you still believe that? The Fed still believes the projected level of real GDP remains above potential this year. That's odd. The gap was expected to have closed by the second half of 2023. The unemployment rate was projected to start rising in the second half of 2022 and to reach the staff's estimate at its natural rate at the end of next year. Well, this was when unemployment was 3.6. The last report, unemployment went to 3.5. And then we're going to see a September report to see where it is. But if we looked at what their staff projections were, they have unemployment reaching a much higher rate by the end of the year than where it is. It's going the wrong way. Total PCE price inflation was expected to be 4.8% in 2022, and core inflation was expected to be 4%. Core PCE price inflation was expected to step down to 2.6% in 2023 and 2% in 2024. This is based on their last summary of economic projections, and we get the next ones in September. So we'll see if they've adjusted any of those. The projected deceleration in core prices was attributable to the anticipated resolution of supply-demand imbalances, a labor market that was expected to become less tight over the projection period, and a projected decline in import price inflation. Well, that's because you have a strong dollar. If that dollar turns around, it kind of messes that up a bit, right? So if the dollar continues to remain strong, you can continue to get subdued to declining inflation in import prices. But if that dollar decides to turn around and the dollar decides to lose value, that's going to work against that advantage. Total PCE inflation was expected to decline to 2.2% in 2023 and to 1.9% in 2024. Total PCE inflation. They see food and energy, they must see food and energy coming down. If total is going to be 1.9, and up here they said core will fall to 2%, total will fall to 1.9, they must see deflation in food and energy. That just doesn't square with the fundamentals of the energy market and the fundamentals of the food growing business, considering the general lack of fertilizer that's traveling around the world, especially with the high cost of natural gas right now and a lot of potassium supply from Russia and Belarus offline. That just doesn't square. So, big question mark on some of these statements here. Down to 1.9, reflecting the anticipated slowing in core inflation and a projected rapid deceleration in consumer food and energy prices in coming quarters. Let's stop right there. A rapid deceleration in consumer food and energy prices. So we're going to look at the energy market. We're going to look at inventories of natural gas. We're going to look at inventories of gasoline and inventories of oil. We're going to look at projections of CapEx and say, you know, if that's all we knew, would we be projecting, and let me use their words, a rapid deceleration in energy prices? I don't know that we would be doing that. So let's have a look at what else we have here. Participants anticipated that U.S. real GDP would expand in the second half of the year, but many expected that growth in economic activity would be at a below-trend pace. So, okay, let's stop there. Let's go back to up here where they were repeating their the summary of economic projections they last made. They expected GDP to remain above potential this year. And the staff is saying, not really, which means in September, we're going to expect to see, when we look at the summary of economic projections, we should expect to see that those projections have been brought down. Many expected that growth in economic activity would be at a below-trend pace, as the period ahead would likely see the response of aggregate demand to tighter financial conditions become stronger and more broad-based. Participants noted that a period of below-trend GDP growth would help reduce inflationary pressures and set the stage for the sustained achievement of the committee's objective of maximum employment and price stability. So they're saying, yeah, we're going to get below-trend GDP, but you know what? That's gonna serve our purposes. So I don't think they're going to stop that. So again, to go through everything that we've seen, they're okay with everything. They seemed a little bit concerned about economic activity, but this paragraph is saying, yeah, we expect that to happen, but that's only gonna help us. Let it happen. Participants commented that they were seeing many signs in the data of slower growth in consumer spending. And when we had retail sales, it does appear that there was a slowdown in retail in consumer spending. Participants also observed that housing activity had weakened notably. Yes, it has, reflecting the impact of higher mortgage interest rates and house prices on home affordability. So, yeah, they noticed that, and that's right. They noticed a bit of a slowdown in consumer spending, and yeah, we can sort of say that happened as well. A few participants indicated that some business contacts had assessed that demand and supply were beginning to come into better balance, which is good for inflation. Even so, contacts in many areas continued to report major supply chain disruptions and anticipated that these were likely to continue, while also indicating that there were signs of improvement in supply conditions in some areas. So some things are getting better, some things are not getting better. Can't take much from that. There were some tentative signs of a softening outlook for the labor market. Increases in weekly initial employment insurance claims, that went the other way last week. Reductions in quit rates and vacancies, still very elevated. Even though you had a reduction, that's like reducing the lineup outside your club from 300 people to 250. You're still never going to get the 250 people in. Slower growth in payrolls than earlier in the year, and reports of cutbacks in hiring in some sectors. Now, this slower growth in payrolls, well, that got thrown out the window with the August jobs report, 528,000. So that got thrown out the window. So now they're going to assess that and say, well, yeah, we did see some tentative signs, but now it's mixed. There's some signs that say, no, it's not slowing down, and some signs saying it's slowing down, but maybe not fast enough. In addition, although nominal wage growth remains strong according to a wide range of measures, there were some signs of a leveling off or edging down. In some districts, contacts had suggested labor demand supply imbalance might be diminishing, with firms being more successful in hiring and retaining workers and under less pressure to raise wages. Now, that is interesting, because you can look at the 528,000 in August and you could say, it doesn't seem to match the economy. It could be that it's just easier to hire people and firms were able to fill a whole bunch of positions that otherwise they couldn't fill. So that could be a signal that, yeah, the job market might be coming into balance, because you had that big job gain. It just might have been that the job market just got easier to hire from, and that's why all these positions got filled, and that's why we saw the JOLTS report, the openings drop like 600,000 month over month, because maybe a whole bunch of them just got filled. That could be it. What else do we have? Let's see. The contribution that increases in labor supply could make to reducing labor market imbalances was likely limited, especially as the scope for labor force participation to pick up was constrained by the ongoing movement of the large baby boom cohort into their retirement years. And yeah, the August jobs report showed that the participation rate ticked down yet again. One of the interesting things that you can look at, if you go to Fred and you look at U.S. population and you look at it over a period of time, they infer a certain population rate over a period of time. It's basically flatlining since the pandemic, because you had 1 million deaths because of COVID, and you had almost no immigration to offset that. You had less immigration coming in than you had the number of deaths. So that you have actually a flatlining population with a shrinking participation rate. Those things don't turn around overnight. Participants observed that in part because of tighter financial conditions and an associated moderation in the growth of aggregate demand, growth in employment would likely slow further in the period ahead. Well, yeah, we had that August jobs report. We got the September one, not at the end of this week, but at the end of next week coming up. So we're 2 weeks away from seeing another jobs report. I know there's a lot highlighted here, but I feel it's important to get the feel of what's going on in that room. There are chapter markers below this video. If you don't want to sit through, paragraph by paragraph of this, you can skip it. Participants remarked that a moderation in labor market conditions would likely involve a decline in the number of job openings, as well as a moderate increase in unemployment from the current very low rate. A couple of participants indicated that firms were keen to retain workers, a factor that could limit the increase in layoffs associated with slowing labor market. So they are aware that this is going to cause a higher level of unemployment. They are aware of it. Indicators of spending and production pointed to less underlying strength in economic activity than was suggested by indicators of labor market activity. With employment growth still strong, the weakening in spending data implied unusually large negative readings on labor productivity growth for the year so far. And when you have that going on, let's say that you have wages climbing at 6%, but you have output climbing at 1%. Well, that is negative productivity. And if you have negative productivity, that is one of the inputs into your forecast for GDP growth. You have to forecast negative GDP growth. Participants remarked that the strength of the labor market suggested that economic activity may be stronger than implied by the current GDP data, with several participants raising the possibility that the discrepancy might ultimately be resolved by GDP being revised upward. And this week, we are getting our second look at second quarter GDP. And the expectation is that it will be revised up. And if it is revised up, well, that gives more of a green light for the Fed to raise rates. So we have to look at what the second quarter revision would be. But we have talked about Q1 and Q2 GDP. And I've shown that, listen, if you remove those anomalies and we look at the consumer is still quite strong. So I don't think that those two reports from the beginning of the year are a good measure. Yeah, they were negative, but I don't think they're a good measure of the underlying strength of the economy. But we'll see this week with second quarter GDP if it is revised up. If it is, that'll be interesting. Several participants also observed, however, that the labor market might not be as tight as some indicators suggested. And they noted that data provided by the payroll processor ADP and employment, as reported in the household survey, both seem to imply a softer labor market than that suggested by the still robust growth in the payroll employment as reported in the establishment survey. This has been pointed out quite a bit by analysts and in the media, that there is this discrepancy of how many jobs were really added. The household survey is saying one number, the establishment survey is saying another number, and it's a difference of 1.8 million jobs. As far as ADP stopped predicting because their model was so miscalibrated. This was about a year ago where they said, we're going to just discontinue the use of the model for a while because for the last 15 years, they've developed a reputation as being known as the always wrong ADP report. They were always way off, always way off. I did mention that the difference between the household and the establishment survey is that for the household survey, you have to be within a particular age range. If you're outside that age range, we're not asking you any questions. When they ask somebody if they are employed, they're not asking how many jobs you're employed by, just are you employed, part-time, full-time. Well, if you go onto Google and you type in NBC overemployed, they did a special on what's called overemployment. People working from home with multiple jobs. And of course, it's no surprise that everybody they interviewed wanted to be anonymous and their voice muted or turned into those robot voices or the devil voices. So they didn't want to be known. One IT person said that they have accepted and are working at 11 full-time jobs. 11 full-time jobs. And they were able to find many people who are working at home, because you can't verify anymore, who have more than one full-time job, working part-time for each company, but getting full-time paychecks. So the discrepancy of 1.8 from the household to the establishment, I don't see that as a discrepancy, but as a clue, as a very big clue that those kind of stories are probably more prevalent than what you think. So if somebody takes 2 jobs, the establishment survey says, aha, 2 jobs were added, but the household survey says 1 job was added. And all these people who have multiple full-time jobs because they're working at home thinking they're getting away with something, well, that one IT person, that's 11 jobs on the establishment survey, but 1 job on the household survey. So there is a difference in what is there. Not only that, the household survey, as I said, won't count you if you're outside the age range that they're looking at, but the establishment survey doesn't ask for age, just says, yeah, we hired someone. There is no, well, don't tell us if it's below this number or above that age, just don't count it. It's counted. So it wouldn't take much, especially in a situation where you have such a lack of visibility. I mean, if you have to show up at the office, it's kind of hard to have 2 full-time jobs at the same time. Kind of hard. But if you're working from home, it's pretty easy to have 2 full-time jobs and get away with it. So I don't think that there's a discrepancy. I think both numbers are telling the truth, and that the gap, that 1.8, is the extent of the 2 jobs, is the extent of the number of people who are collecting 2 full-time paychecks and working 2 part-time jobs. Let's continue on. Participants observed that inflation remained unacceptably high. Now we're getting into the inflation stuff. Unacceptably high, and was well above the committee's longer run goal of 2%. Participants further observed that inflationary pressures were broad-based, a pattern reflected in large 1-month increases in the trimmed mean CPI and core CPI measures. Notice what they're mentioning here, trimmed mean, core. That's what we're going to pay attention to as well. Participants remarked that although recent declines in gasoline prices would likely help produce lower headline inflation in the short term, declines in the prices of oil and some other commodities could not be relied on as providing a basis for sustained lower inflation, as these prices could quickly rebound. Yes, that's the thing with commodity prices. You can have gasoline prices coming down, but we're going to look at inventories here shortly. And it would not be surprising to see gasoline prices recover, to see oil prices recover. That would not be surprising at all. We're already seeing a little bit of that in copper as well. So I think the big declines so far have been in wheat, because a lot of it is coming out of Ukraine right now, and in oil because of this fear of China slowing down. There's going to be less demand, there's going to be a recession, and if you really want to make a dent in prices, nothing does it like a recession. But that is kind of interesting how they're paying attention to, they're mentioning trimmed mean, and they're saying you can't rely on this stuff. Falling gasoline prices, falling commodity price, you can't rely on that because they could easily just turn around. You got to look past it. So they're going to look at, what's this next word here? Core. Participants agreed that there was little evidence to date that inflationary pressures were subsiding. They judged that inflation would respond to monetary policy tightening and the associated moderation in economic activity. The associated moderation in economic activity. So they are saying it's a trade-off. We know it's a trade-off, and we're willing to make it. Moderation in economic activity with a delay, and would likely stay uncomfortably high for some time. Participants also observed that in some product categories, the rate of price increase could well pick up further in the short run, with sizable additional increases in residential rental expenses being especially likely. Yeah, because these are reset every year. So a bunch of tenants who are coming to the end of their annual rental term at the end of August, at the end of September, are going to have rate resets to market rate, and up the prices go. So that will continue for some time. What do we got here? Some signs of gradual improvement in the supply situation, including improved availability of certain key materials, less upward pressure on input prices, and a decline in delivery times. Contacts reported that there were nevertheless substantial continuing challenges. Participants judged that it would take considerable time for supply constraints to be resolved, and a few suggested that full resolution of supply difficulties would take longer than they previously assessed. They sound like they're getting ready to pivot. Participants emphasized that a slowing in aggregate demand would play an important role in reducing inflationary pressures. They want that. They want a reduction in aggregate demand. It would play an important role in reducing inflationary pressures. Well, aggregate payrolls increasing and credit availability actually improving since the last meeting is not going to slow aggregate demand. And if they say the slowing of aggregate demand will play an important role, and it's not going to play that role, what do you think they're going to do? Participants discussed a number of factors likely to be helpful in bringing down inflation back to 2%. Okay, good. What are they? The committee's ongoing policy firming and anchored longer-term inflation expectations. Competitive pressures restraining price increases, meaning higher prices bring in more competition, more supply lowers prices. Apparent absence of a wage price spiral. Don't know what they're looking at there because I'm seeing the beginnings of a wage price spiral, but they're saying the apparent absence. Tightening of monetary policy abroad and the impact of appreciation on the dollar on import prices. So there we go. They're pointing out that the strong dollar is helping on that front. So you don't want a weakening dollar. So if there's any sign that the Fed is going to pivot, they have to know this. They say, listen, if we signal that we are going to pivot, that we are going to slow down, this dollar is going to drop. And if the dollar drops, well, there goes one of the important, it says here, number of factors likely to be helpful. We'll lose this factor. Right here, we're going to lose that factor right here. And if we lose that factor, inflation will start to show up again, and then you'll start to get evidence of the wage price spiral that is more obvious than, the beginning patterns of it. So, rock in a hard place, right? They continue to view commodity price developments as a potential source of upward pressure on inflation. Participants noted, I should say a note about that. Again, that was before, the commodity prices were coming down. Some of them have really come down. Some of them have come down and have started turning back up again. And that's, going back to the paragraph we saw on the other side. They said you can't rely on this commodity price stuff. It's way too volatile. Participants noted that expectations of inflation were an important influence on the behavior of actual inflation and stressed that moving to an appropriately restrictive stance of policy was essential for avoiding an unanchoring of inflation expectation. I think that's a good sum-up paragraph right there. Moving to an appropriately restrictive stance. What do they mean by appropriately? But they're saying restrictive. An appropriately restrictive stance was essential. And I think we got just a little bit more and we're done. In their consideration of the appropriate stance of monetary policy, participants concurred that the labor market was very tight and that inflation was far above the committee's 2% inflation objective. In that sentence, they've stated what their dual policy is. Labor market, inflation. They said that labor market is very tight. Check that box. Inflation was far above the committee's 2%. That box is not checked. Against this backdrop, all participants agreed that it was appropriate to raise the target range for the federal funds rate 75 basis points at this meeting. Participants observed that following this meeting's policy rate hike, the nominal federal funds rate would be within the range of their estimates of its long-run neutral rate. Its long-run neutral rate. So we're going to look at a number of charts that place the federal funds rate, because, if they think it's the neutral rate, we'll call it the neutral rate. That we'll look at the federal funds rate in relation to the measures of CPI that they've chosen. And we'll ask ourselves if a negative neutral rate makes any sense at all. If they think we're at the neutral rate, because the neutral rate is a nominal rate now, if we think we're at the neutral rate, they must mean that the real neutral rate is negative. They have to mean that. Even so, with inflation elevated and expected to remain so over the near term, some participants emphasized that the real federal funds rate would likely still be below the shorter run neutral levels after this meeting's policy rate. So they do give a nod to the real federal funds rate, saying nominally, we think we're there. However, when we consider the real rate, I don't think we're there. So on a real basis, they are at least acknowledging that they're not there. In discussing potential policy actions at upcoming meetings, participants continue to anticipate that ongoing increase in the target range for the federal funds rate would be appropriate to achieve the committee's objectives. With inflation remaining well above the committee's objectives, participants judged that moving to a restrictive stance of policy was required. So we know they're gonna move. Question is, are they going to move more than 100 basis points from now to the end of the year, as the market expects, or are they going to move by more? Participants judged that as the stance of monetary policy tightened further, it likely would become appropriate at some point, and I've changed the color here, to slow the pace of policy rate increases. Slow increases. Not stop, not reverse, slow increases. Still increasing, but slow the increases. Well, duh. Did we think that they were going to raise 75 basis points at every meeting forever? At some point, it would become appropriate to slow that shit down. I mean, that is a statement that doesn't need to be said. Everyone expected that. Here's an analogy. Imagine if I said this. You cooked me a meal, I sat down, I started eating. And you said, well, how is it? Now, I can say one of two things. I can say it's great, or I could say it's great, but at some point, it's going to be appropriate for me to stop eating. Well, duh, I'm not going to eat forever. I'm not going to eat for 4 hours. Yes, at some point, it's going to be appropriate for me to stop eating. But if I said that in answer to your question, how is it? And I said, it's good, but at some point, it would be appropriate for me to stop eating. Would you say, well, of course, or would you say, well, hang on, what do you mean by that? You don't like it, do you? Right? I mean, I'm saying something that is, well, of course it's gonna be appropriate to slow it down. No one expected you to keep going, but the very statement, the very making of that statement is what has caused all of this confusion in the market. That didn't need to be said, because it's one of those, well, duh, at some point today, it will be appropriate for me to go to sleep. Right? At some point today, it will be appropriate for me to drink some fluids. At some point today, it will be appropriate for me to eat some food. Well, those are all true statements that don't need to be said, but the very saying of them raises the question of why are you saying that for? What's going on? That's just my interpretation of this. I mean, I don't think anyone expected that they'll continue on with 75 basis points forever. At some point, it would have been appropriate. Yeah, you're saying an obvious statement. Let's see, where are we? Once the policy rate has reached a sufficiently restrictive level, it likely would be appropriate to maintain that level for some time to ensure that inflation was firmly on the path back to 2%. So that is the longer. I've been saying higher for longer. That's the longer part. The idea that they were going to just raise it and then turn around and head right back to the zero line, to me, just didn't seem like a realistic statement at all. It's not a realistic statement, and I think they're saying that too. And a lot of Fed speak last week said the same thing, that the idea that the market thinks we're going to start cutting rates, early next year is premature. Some even called it fantasy. It's just pure fantasy. So you can expect that it will be longer. Now, go back to what I showed you about the yield curve being less inverted and why it was. Because the market is now predicting that the path of the short rate will be higher for longer. So the fact that we are less inverted by the 10-year going up, by the longer end of the curve going up, is feedback saying, aha, the market is kind of figuring out that we will be there for longer. So they are moving towards that understanding. We're almost done. We only have this blue stuff and then we're all done here. In light of the elevated inflation and the upside risks to the outlook for inflation, participants remarked that moving to a restrictive stance of policy in the near term would be appropriate from a risk management perspective because it would better position the committee to raise the policy rate further to appropriately restrictive levels if inflation were to run higher than expected. There was also a risk that the committee, and this is, I think where the market, when they got the minutes, this is where the market said, hang on a second, this is good. There was also a risk that the committee could tighten the stance of policy by more than necessary to restore price stability. These participants highlighted this risk as underscoring the importance of the committee's data-dependent approach to judging the pace and magnitude of policy firming over the coming quarters. So yeah, we got to get rid of inflation, but it's saying here, hang on, we might make a mistake. Participants remarked that it would likely take some time for inflation to move down to the committee's objective. Participants recognized that policy firming could slow the pace of economic growth, but they saw the return of inflation to 2% as critical to achieving maximum employment on a sustained basis. So let me just sum up with a few things here. As far as the Fed is concerned, we see no issues in credit markets. We see no issues in housing market. We see no issues in bank stability. We see no issues in the labor market. And yes, while raising rates is going to affect the economy somewhat, we're perfectly willing to do that. So I don't know where the market is getting this idea that the Fed is going to pivot. They're going to pivot. They're going to slow down the rate of increases and stay there for some time. That's what I take away from this. Anyways, thanks for staying with me for that long. We read a lot of this, but I do think it is important that we get insight into what goes on in that room. Okay, let's have a look at the Fed funds rate. It is right here on both charts. It is the darker reddish brown one that we see, if I can get my ink to work on that screen, right there. So here it is the top line, here it is the top line as well. When we talk about the inflation rate, there's always the question of which inflation rate are we talking about, headline or core. We can start there. Core is less volatile because it has sticky components. Headline is more flexible. It has a lot of volatility in it. So if we're looking for the underlying trend, a more smooth series, we would look at core. And in the meetings we've seen, or in the minutes, we've seen they tend more towards core. That is their preferred measure. Well, there's the PCE and the CPI. The PCE is the cost of living, CPI is the price level, and we know that they are more focused on the PCE. So far we're at core PCE. Year over year or month over month annualized. Year over year is backwards looking because if you draw a timeline and we're over here, it is the price increase over this period of time. If we want a forward looking measure, we could say, well, let's take the last month and we'll annualize it as our forward looking. So year over year or month over month annualized. This is be forward looking, but it's going to be volatile because month to month it's volatile. So we can use a 3 or a 6 month moving average on the PCE, core PCE. So we can take the last 3 months of core PCE and just use a 3 month moving average. Every time we get a new PCE measure, add it to our series and drop off the further month and just have this moving average. But if you're going to use a 3 or 6 month moving average, are you going to just stick with core PCE, a 3 month moving average or a 6 month moving average on core? Or are you going to say, well, there are some flexible components of core. Maybe we should focus on just the sticky core. And if we're focusing on the sticky core, somebody say, well, if this is a more flexible, why look at the sticky core? Why not just look at a trimmed mean and we don't have to worry about trying to figure out what are the sticky components? So core too flexible, why not a trimmed mean? Well, what trimming? 16%, 8%? How are you going to trim it? Well, I'll tell you what. Let's just use the median price change, a 3 month moving average or a 6 month moving average of the median. You can see that there are a lot of choices that you can make to try to get to something, which means they're probably going to look at a couple. This one here is Sticky Price Consumer Price Index less food and energy. So this is the sticky core. This is 3 months annualized. Now look at it. It has a start point sometime in the late 60s. But look at where the blue line is in relation to the red line almost at all times. It is below. That the effective funds rate is above that particular line almost all the time. But look what's going on here. It is above. It has always been, the federal funds rate has always been above, which can help explain this type of moderating that we saw in inflation, because we called this period the Great Moderation. The Great Moderation because the effective funds rate was higher than the sticky PCI, the 3 month annualized sticky PCI. Let's try some different measures here. We have a trimmed mean PCE inflation rate. This is the 6 month annualized trimmed mean. So we went from core saying, well, okay, you don't like some of the flexible components. Let's just trim those out. Let's just, we used the sticky core. And instead of trying to guess what's flexible, take the core and just trim it. And that's where we get the trimmed mean PCE, and it's 6-month annualized. The green line down here is just core. It's just core PCE. So it is this one over here, just core PCE year over year. This one over here is trimmed mean PCE, is the trimmed mean PCE headline, but you're trimming it out, so you're probably, most of the stuff that's being cut out is probably food and energy. And let's have a look at where we are. Notice the red line for most of the time is above those two lines, except for this period of time over here, and now we have this going on over here. But the effective federal funds rate at all times was, not at all times, but the vast majority of the time was higher than all of the of each of those two inflation reads, which is why you have this, what we call the great moderation over that period of time. You did have a period of time here where it was under, and if you follow the trend here, inflation did rise for that period of time, hence the increase in the federal funds rate as that was increasing. This was the anomaly. And I have pointed this out before that, you know, you had the federal funds rate at zero for almost a full decade, and you had a balance sheet that was increasing, but you had no inflation during this period of time. Why did we have no inflation during this period of time? It could be related to the level of capital expenditure by a lot of companies around the world, that it was a period of benign capital investment. So that maybe it was the lack of that capital investment, the lack of that CapEx investment that drove the demand for commodities and then created inflation. And then this is what did it over here. That was the breaking point. But we have this period now where the inflation line is above the effective federal funds rate, meaning we have a negative real federal funds rate. So if we think we are at the neutral rate, where we are right now, you must accept that the neutral rate is a negative rate, I'll just put real in brackets, that the neutral rate must be a negative real rate. These are all positive real rates here, positive real rates, all positive real rates. Whenever the red line is above the inflation rate, these are positive real rates, all positive real rates, negative real rates, and suddenly we're at neutral. Well, that's all I have to say on that. I think we can infer, we can see the disconnect at this end of the chart. I don't think saying that they're at neutral is defensible in the least. Okay, this is a super interesting screen. Let's say that, okay, I've said everything that I've said so far in this video. What is the likely path of the economy? Where are we headed? And we can have a whole bunch of ideas in our head based on what we've read and what we think. Typically, what we would like to do is start with what are called base rates. What is the probability of certain things happening? We'll look at the past. What is the probability of moving from one type of economy to another type of economy? Those are base rates. And then from the base rates, we can then determine if we want to adjust any of those probabilities. But if we say, well, what's the probability of inflation going down and growth picking up based on where we are now? Well, what has been the probability of that happening in the past? How many times have we been in this situation and we simply just transition to that next state? So I read a paper that had already done that, and I thought, this is fantastic. So here's what they did. They looked at the composite leading index month over month. And if the composite leading index month over month was increasing, we were over here. If it was decreasing, we were over here. Then every month they looked at just in the CPI, they looked at the 3-month average annualized of the CPI versus the average 3-year rate. And if the 3-month was greater than the 3-year rate, inflation was rising. If not, inflation was dropping. This, for technical analysts out there, you'll notice that this is just a fast-moving average and a slow-moving average, and it's just the fast-moving average moving above the slow-moving average you know what that means. Well, we are right here because we have the 3-month annualized CPI greater than the 3-year, and we have decreases in the CLI. For the last 5 months we've had this, and for the last 16 months we've had this situation over here, so we're over here. What are these numbers here? This is the percentage of the time over the observation period, which was 76 onwards, that we've been in these regimes. 40% of the time, the 3-month inflation annualized is less than the 3-year, and the CLI is pointing up 40% of the time. 32% of the time, it's pointing downwards, but inflation is benign. Here, inflation is hot, and we're still expanding. The leading index is pointing up 11% of the time, and 17% of the time inflation is hotter than it needs to be, and the leading index is pointing down. And again, we've had this for 5 months, and we've had this for 16 months, so we're fully entrenched here. So the question is, well, if we observe ourselves here, what is the probability of the next state over the next 3 months? In other words, in 1 quarter, where are we going to be? So we look at history and say, well, where were we 3 months after we observed that we were in that state? So let's start with this state over here. If you're in this state, 55% of the time you stay in that state 3 months later. 6% of the time you go down. This, by the way, is the best state to be in, the preferred state, right? 6% of the time we get down here. 11% of the time we fall over here, and you could say that this is recession. Leading index is pointing down, inflation is dropping. Typically that's what happens in recessions. 11% of the time. 28% of the time, if you have elevated inflation, you simply turn into elevated inflation with the leading index turning down. Now, we did have that for a period of time. You had 11 months of having inflation above where you want it to be, with the leading index pointing up. Now the leading index is pointing down, so we were here and we've moved here, and we've been there for 5 months. So here we are here. There's a 58% probability that over the next quarter we stay exactly where we are. A 23% probability that we move back over here to having the leading index pointing up, but inflation not doing anything. 8% that we get to the preferred state, and 12% that the leading index points down and that inflation comes down, and this happens with recession. So when you do move from this state, there's a 58% probability you stay in this state, but when you do move from this state, 29% of the time you end up in recession. 55% of the time you end up with sticky inflation, and 19% of the time it all just works out. So this is what we're betting on now. The base rate for it all just working out is 19% based on history. That we have less than a 20% chance that it's all just going to work out. We have a 55% chance that we will have positive GDP growth going forward, that the leading indicators will start to point up, but that we end up with sticky inflation. So rates will be higher for longer, and you got a 29% chance that we'll be in a recession. So it all working out has the least probability. A 19% probability. It's the least probable outcome. The most probable outcome is inflation for a long period of time, but we could have growth with inflation. That means the central bank will continue to raise rates, so I certainly don't want to be in the home builders under a scenario like that, but I don't mind being in energy under a situation like that. Here, I don't mind being in energy either. Here, I don't want to be in energy or in home builders. Here, I don't really want to be in anything. I'd like to be in cash. But I've got a 55 plus 19. I got roughly a 74% probability of being on this side and 29% in recession. So when somebody says there's about a 30% chance of recession at any given time, look at that number, 29%. So you have to ask yourself, based on where we are now, you can then change these numbers. These are historical numbers, but do you assign a higher probability than 30% to recession? To say it's less than 30%, but empirically in history, it's been 30%. So To say it's less than 30% would be odd. When you are here, we observe recessions 30% of the time. So that would be your base case for a recession is 30%. If you think, well, no, I don't think there's a recession, you still got to count that, well, 30% because historically that has happened. This is the danger here. Now, I'm aware of this, and I know that the people who work for the Federal Reserve probably read in the same academic journals that I do and probably read the same stuff I do, that somebody somewhere has read this, that somebody somewhere knows this. It's not a big secret. So, and I think this is where the fear is in the Federal Reserve, is ending up over here. And this is where the hope is in the market right now. Okay, let's have a quick look at retail sales, and I just took a snapshot from retail sales. This is all we really need. We'll go through each of the lines here. So if we're looking at the headline number, retail and food services total, here is the number for July. This is adjusted. It's adjusted to account for the same number of days year over year. And if the holiday fell in or out of the day, that's adjusted for the holiday sales so that you have as fair a comparison as you possibly can. 0.034% month over month. So annualized is 0.4%. If we take the month over month and annualize it, that's an annualized rate of 0.4. Annualized. That's pretty low considering where inflation is annualized. It is 10.28% year over year. But month over month, it's not very good at all. For retail, if we just take retail, that means we're going to get rid of food, motor vehicles, parts, gasoline, all that, and just stick with retail. 0.0286% month over month, or 0.34% annualized. It is lower than this versus 10.08% year over year. So year over year was 10, but if we take last month annualized, we're all the way down to 0.34, almost non-existent growth. Meanwhile, year over year, we've had wage increases, so that the difference between June and July, the wage increase in July over July last year, should suggest that we should have seen some growth over June, or not. So that was the ugliness of that particular report. Let's look at some of these categories here. Let's take out motor vehicles and parts. That is 0.4147% month over month, or 5% annualized versus almost 12.5% year over year. If we just take out gasoline stations, that means it's the top line just minus gasoline stations, 0.339 or 4.14% annualized. That is 7.43% year over year by taking out gas. And if we take out both cars and gas, it is 9.03% annualized versus 9% year over year. Okay, so gas, we can see taking out gas because it crowds out other purchases, and being that we have such a supply constraint in the automobile sector, prices are distorted there. They're way over where they should be, especially in the used car market, even though it's been coming down. Let's just take that out, control for that, and let's just see what's really going on under the surface. That's not so bad. 9.03% annualized versus 9.32% year over year. That's not so bad. Let's try to see if we can make sense of the motor vehicles. Motor vehicles and parts dealers, there is a separate line item just for that. This is the total excluding motor vehicles and parts. If you read down the report, there is one line here, month over month, negative 1.98. It has an autos only, negative 1.74 month over month. So look at year over year. Month over month annualized is negative 21.4. Here it's negative 19. Meanwhile, autos year over year is up 1.5, and this category, the whole category, is up 2.1% year over year. So there is that's telling me there's a deceleration from June to July when you take this loss and you annualize it. The negative 1.74 we get, this is retail sales. It controls for a bunch of things except price. So these are nominal numbers, which means this headline here, when we say we're down 1.74%, that's a combination of price and quantity. We're down in July 1.74% over June from a combination of price and quantity. So let's see if we can pull it apart. Quantity, we had U.S. vehicle sales for July. They were up 2.5% month over month. Well, if they're up 2.5%, and this is a combination of price times quantity, and this has got a positive number, price must have a negative number, negative 4.13%. Okay, let's go to the CPI and see if that makes sense. Month over month, new vehicle sales were up 0.6, used were down negative 0.4. They're weighted. If we're figuring out this 4.13, since this is auto dealers, this is new and used, so we got to weight these. Typically, vehicle sales are 30% new, 70% used. So if we weight it, we get negative 0.04, not negative 0.413. So that doesn't match up. So the only conclusion could be is that inventory on dealership lots is rising. So if you want to test that particular theory, next time you're driving past a dealership lot, have a look. Does it look like they have more cars on the lot? Because this number here is the automaker saying our car sales are up, but they could have sold it to the dealership sells it to the consumer. Selling it to the dealership, there's your 2.5. Selling it to the consumer, here's your number over here. So this might have been negative Q over here because this was not negative 4.13. This, based on CPI, was negative 0.04, which means you had to have your Q would have had to have shown something along those lines as well. You would have had to have some kind of price decline along with some kind of quantity decline to get to negative 1.74. So we're missing a quantity decline. So it has to be that inventory is rising on dealership lots. This is the kind of interesting stuff that you can pull out of these retail sales reports. It's broken down by a number of industries. So you can go to the particular industry that you're interested in and you can look at what the retail sales trend was for that industry. Earlier, for the home builders, we saw that if we went to that particular industry category, it was up 1.5% month over month, which was good for that particular industry. For motor vehicles and parts, we see that it is down annualized. That's not very good, but we would expect to see this kind of thing. The higher the ticket item is based on sensitivity to interest rates. So anyways, there's retail sales. On a headline basis, not very good at all. You have to dig to find the good news, and then from the good news, you got to say, well, you know, what should we pay attention to, this underlying trend, or should we pay attention to the headline? The headline is not good at all, but when you dive below the surface, some of the categories are good, some of the categories are not good. Okay, the links for both of the reports we'll go through here are in the description box. This is the week in petroleum. And a lot of interesting stuff in here. Open interest, if you scroll down, it tells you where the open interest is from the long position, the short position. Keep going down. Here's our inventory down here, crude stocks. This is the range of the 5-year average. The middle of the band would be, middle of the road. Well, you can see it's ticking up, but we're still way at the lower end of the range. We can come up here, we can click on crude oil to get a better look at the inventory level, and here we are. So it has been, since down here, we can see that it has been trending up. It is now within the range. It was way below the range here. It has been trending up within the range here. So we are heading in the right direction. So we can understand why the term structure of futures prices have become less backwardated. Still in backwardation, but less steep, because we are moving into this particular zone. From here, you'd have to determine, well, where do we go from here? That's part of the game, right? Let's look at gasoline. We'll look at the inventories there. And the inventories have been turning down. And if we look at gasoline prices over the last, I'd probably say week, a little bit more than a week, we have seen that they have stopped dropping and have reversed and are now turning up. So this should, for gas prices to keep falling, you had to have this kind of thing going on. See this part of the curve here? And you had to have it come into this range. Well, it is now turning right back down again. So that is going to put upward pressure on gasoline. Let's look at natural gas. This is weekly natural gas storage report. And the dark band is the mid part, or what's called the 5-year average, and this is the band around the 5-year average. When the blue line is above, you're going to have very soft natural gas prices. As it moves below, you're going to have very firm natural gas prices, which means upward pressure on prices. Here we are here, coming near this dotted line is the end of August. There we are here. We're sort of now moving sideways out of this band, which is putting upward pressure on nat gas prices, and we've seen how tight that particular market is. And a lot of this depends on what we think is going to happen in Europe for the winter. If Russia turns off the nat gas coming out of Russia, it is going to be an ugly time in Europe coming this winter. They are trying to build inventories for the winter, but Nord Stream 2 was shut down again, I think for 3 days, which kind of messes up their plans to build inventory. Maybe, Putin is looking over there saying, you think you're going to build inventories, you're not. I need you on the edge. I need you on the edge all winter long. And the colder and more brutal the winter is, the better it is going to be for Russia because, well, what are you going to do? So you can try to get liquefied natural gas over there, which is why you have such tight natural gas markets right now, is because a lot of it can be sent over there if that falls apart. So that's where we are right now in terms of energy. We're thinking that on the last headline report, we saw headline come down. Annualized headline was 0, but annualized core was 4% on the CPI. And the minutes said, you can't pay attention to this stuff because, commodity prices can go down, but they can come right back up again. For gasoline and for natural gas, I don't know that you're going to get much relief. And if you think that this is expensive, by the way, if you want to compare the price of natural gas with the price of oil, multiply the price of natural gas by 5.8, and that is the barrel equivalent of energy. So you can see that nat gas is still a lot cheaper than oil for electricity generation. If you multiply by 5.8, I think you'll get to a little over $50 in the US versus 80, 90, I think it's like 90, 91 for WTI. Now multiply that number by, I think, almost 5 or 6, the 50, by almost 5 or 6 to get where Europe is right now. And if there is going to be a problem in the winter, you can multiply that by 12 to 15 times. Now imagine your heating bill this winter being 15 times more than normal. What is that going to do to consumer spending? What are you going to do? Say, I'll live with the cold. I'll just, it's below 0 outside. You're just going to live with the cold. You're not. Now, a lot of Europe has northern climates. You get up into Germany and Norway and places like that. I don't know if they rely too much on Russian gas, but there's a lot of northern elevations. You're going to need heating. You're going to pay those prices. If 40% of the S&P's revenues come from outside of the country, and that is going on, well, what do you think is going to happen to estimates for earnings, right? So it's I think risky going forward, betting on the market, continually booking gains when you have the energy market saying, this looks tight. So with that, let's look at the XLE, which is an ETF, has 21 components. And I always find that if you have no particular reason to pick one company over another company, it's always better to grab an ETF that has a whole bunch of them in there. Who's going to be the profitable ones? Nat gas, oil-based companies, or the oil services companies? If you really have no opinion about it, why not grab an ETF that tracks a bunch of them? So the XLE has that 21 components. The top 4, Exxon, Chevron, Conoco, and Occidental. And Occidental is Warren Buffett's target. He has approval now to buy up to 50% of OCI. So if you do want exposure to that, you get it within a diversified portfolio. You do have some OCI exposure. I think this is about 5%. But these top four make up 53.4% of the index. Has a nice big fat dividend, 3.4%. So you do get paid to wait on this one. And if we think that the story of energy is in play, very little reason to increase your capex, very little reason to engage in any new exploration of any new fields. You're pretty much going to harvest what you have, only because countries and auto companies around the world have pretty much said we're going to obsolete your product. And if we expect that Russian oil and Russian energy is eventually going to be off the market, it's got to be taken up somewhere else. I think that a position in XLE kind of makes sense. Now, if you're long S&P, if you're long the SPYs, which is the ETF that tracks SPY, you've got about a 4.5% exposure in SPY. You got about a 4.5% exposure to XLE anyways. That if you were long SPY and you wanted to be overweight XLE, you could add the XLE as well, and you would still be long the rest of the market, but you'd have an overweighting on energy by adding XLE. 3.4% dividend versus SPY, I think, has about a 1.6% dividend, 1.7% dividend right now. So you are getting paid. You are getting paid to wait. They do pay quarterly. They do have options, so you can engineer a trade with options. So you could say, well, maybe I don't want this entry price. Maybe I want a lower entry price. You can sell a put on it, If you like the fundamentals of where the industry is in terms of where their level of inventories are, they're at such, like near their 5-year lows or even below their 5-year lows. And with what's coming up, could be an interesting sector. I know Warren Buffett is loading up on OCI, so he sees something in there. Okay, we're almost done. We just got to take a quick tour through this week in earnings, and then we'll look at the week ahead, and we'll wrap up. I know it's a long one this week, but we had a big Fed meeting. Well, that's not good, right? I mean, it's not that bad overall, but it's not that good. We've sort of come down based on who reported last week. If we scroll down to the forward earnings, because that's what we care about the most, let's see what happened. Forward 4 quarters, 232.60. That has come down from last week, not by much. I think it was like 30 cents, 35 cents it's come down by, not by much, but it has come down. And I think we do have some reporters this week, some that are reporting this week. Who have we got? Nordson, nothing much there. Not much to look at here. Autodesk, Salesforce, Nvidia, that'll be a big one there, Nvidia. And wow, look at this, you've got Dollar Tree and Dollar General. Both of them are in consumer discretionary, believe it or not. Now they're leaving consumer discretionary next year and going over to consumer staples, but they'll be reporting at the end of the on Thursday. Do we have anything on Friday? Nothing on Friday. Let's look at the week ahead. It's a fairly big week. Okay, our economic calendar for the next week. I've got Canada and the U.S. up here. We'll pay attention to the U.S. If you want more countries, just click down on here and you can select whatever region you want. Whatever region you select, you'll get all the flags in here, and then you could just deselect the ones you don't really care about. So what do we have here? Nothing till, in the U.S., nothing much till Tuesday. We have PMIs. The last services PMI was 47.3. The forecast is for still below 50, which is contraction, but less contraction. And manufacturing PMI was 52.2, dropping down to 51.9 on the forecast, which means less expansion. So less contraction in services, but less expansion in manufacturing. New home sales, I don't see why this would break with all of the other home sales, with all of the other housing data we've seen. I expect that to be negative. Kashkari is speaking that night at 7 o'clock. Next day, Wednesday, durable goods orders. Our forecast is for 0.5. Previous was 1.9. We have pending home sales at 10 o'clock. I don't expect that to make any kind of break with anything else that we've seen. Then Jackson Hole begins On the next day here, this is Thursday, we get our second look at second quarter GDP. Will it be revised up from what we originally saw, or will it be revised downwards? That'll be interesting to watch. The continuing, here it is, initial jobless claims. That's been getting more attention as an early indicator of the tightness of the labor market. It dipped down last week, down to 250. So it stopped the upward trend in it. What does it come in this week? Forecast 253. If it comes in below 250, well, then this idea of the job market is becoming less tight, it's loosening up, kind of gets put on the sideline for a while. Here's the big day here. 8:30 on Friday, you're getting core PCE. I expect it to follow suit with CPI. I don't know if the market will see it as the same measure, it's the same thing measured differently, or will throw another party because they'll say, aha, it's a completely different measure. Sometimes the market throws a party for the same piece of information if it's presented 3 times from 3 different places. Even though it may be the same information, they want to throw 3 parties. Who knows what's going to happen, but I don't expect that you're going to get such a large difference from the CPI when we see the PCE. The PCE will follow suit, and usually these numbers come in lower than what the CPI has because it does substitute and it does shop around. And it does reflect more of what consumers are buying as opposed to what a price of something is, even if nobody buys it. So I expect it will confirm the CPI report that we saw. So be aware that if you are short going into Friday, you face that risk that the market will throw another party, a completely different party, for the exact same data. They may do that. But it's the core that we should pay attention to, not the headline. The headline's going to come in soft. The headline's going to come in looking like everything's going to be great. It's the core that you have to pay attention to. And you really should be looking at a 3-month average core to figure out whether that direction is up or down. Also, the trimmed mean PCE is something you should look at as well, as opposed to just that one number. And look at that, 10 o'clock. If there is a party at 8:30 and it's not what the Fed wants to see, who knows what kind of remarks you're going to get out of Powell. He's going to be reading from prepared remarks. He's not going to deviate from that. So you'll pretty much have his whole speech at 10 o'clock. The transcript from the speech is released at 10. The market will know what he's going to say before he actually has to read it. It's for something this significant. He's not going to get up there and say, oh, thank you. Whew, so many people to thank. It's not going to be something like that. Then you got Michigan consumer sentiment at the same time as well. So Friday has got huge event risk in here. You got PCE and you got Powell. I don't know how the market is going to interpret PCE. Are they going to focus on core, or are they going to just look at headline and say, good enough, we're grasping at anything you give us, let's throw a party, a completely different party than the one we had last time? So this could be, on Friday, you could have a 100-point rally or a 100-point sell-off, depending on how these things come out. One thing that I feel pretty safe in saying is it's not going to be a meh kind of day. It's not going to be a sideways kind of day. It's either going to be a 100-point rally or a 100-point sell-off. Well, maybe not 100 points, but you know what I mean. It's either going to be a party or it's going to be a bloodbath, one of the two. Anyways, there we are for the week, and I'll see you midweek when I answer some questions.